Hussey with Zaner Ag Hedge. Welcome to this week's Strategy of the Week update. It's 1:30 p.m. Central on February 3rd, 2022. Remember, trading futures involves risk and is not suitable for all investors, and everything I talk about here today is just my own opinion and not a direct trade recommendation. But if you do want to talk about direct trade recommendations, you do want to turn this into more of a trading plan for you, give me a call over here at Zaner, 312-277-0110. Of course, not right now. Won't pick up the phone, but anytime. Always love to talk about turning these into an account or an idea for you. Find me on Twitter, Facebook, or shoot me an email, dhussey@zaner.com. Okay, so I want to begin today. We're going to look at some of, obviously, the technicals and go through the charts like we normally do. Let's begin with the daily chart here of the March soybean contract. We're looking at just that March outright, which actually this is a continuous chart. I do not want the continuous chart. Just the daily. I just want the outright contract because it's not really fair to look at this March as we'll go back in this daily chart here and see old contract highs only got as high as 1435, last summer and through when this contract was, of course, new crop. The market never made it as high as the new crop old crop contracts that year. And in fact, this year we're beginning the rally we saw last January that resulted in, as you can see on this chart, a $4 move from January through the May timeframe. We began this rally last year around the $11 mark for old crop. If you go back and you look at old crop at that time, we were, 11, 12. We ran up to 13, 14, 15, 16 by May. This March contract is beginning much higher. In fact, it's beginning, the beans in the teens was the launching point for this year. And so you take a $4 launching pad from there. March, you could consider old crop corn or beans now going to $17, $18, $20 with that type of momentum if we have a similar move that we saw last year. All right, all intents and purposes, this is a parabolic chart. We've broken out of the old resistance, the old highs at the $14 area. We're into uncharted territory for this March 22 soybean contract. 50-day moving average, 200-day moving average down at 1320. 55-day up around 1344, down around, I should say. 100-day here at 1300. Those are now starting to spread out. We're getting those the crossovers and those golden, bullish kind of underpinnings there. The 18-day moving average is rising now, 1432. We'll expect that to get pulled up here. And certainly, if we're seeing a period of consolidation, it'll give a chance for the moving averages to pull back. The RSI is getting into overbought territory here in the daily time frame. It can stay overbought longer than you can stay short. So that is not something I'm trading off of. Certainly something we're aware of and paying attention to, though. So now that we've broken out of this old resistance in this box in this chart, that's going to be a new support if we were to ever come back down to it. The 50% retracement from the 1180 lows all the way up to the highs, basically the swing, the contract lows to highs here more or less for, or I guess it's not contract, but this last swing's low to highs. We'll take a look at where that level comes in on the chart. It's around 1378. Not saying we'll go down there, but something to be aware of. And there's more aggressive support levels that we'll look at here in a minute for soybeans. It's very hard for me to put a trade on in the soybeans that is really bullish at this point in time. I'm actually thinking more in terms of how do we protect soybeans. I think that at this point in time, a lot of the strategy and a lot of the recommendation and advisory that we gave to clients going into this rally has been, we want to be long for this move, buying courage calls, doing things to the effect of, do you mind? Thank you. Doing things to the effect of making sure we have re-ownership in place so that we could come and do cash sales now via HTAs and other things. And that is, of course, assuming this is all against new crop. Old crop, if we've still got it, go and get those cash sales done with every new contract high. We can use the volatility in the pullbacks to reestablish positions here in the futures with finite risk. And that is where you can start adding the pennies to the game plan and the marketing strategy, while again maintaining that floor for your overall production and honestly for maintaining your profit margins. That's what this is about. At the end of the day, it's about running a business. Thank you. So the move to $16 is not over yet. I do think we can get there in the March contract. I would not be surprised to see a pullback. So let's take a look now at where on the shorter time frame we might find some of that support and where we should be looking for it, certainly here now into the month of February and going forward. Well, we have trendline support, very aggressive trendline support. You can see here that is, keeping this parabolic move parabolic. A line through the 1400, through the lows here again at 1530 today. And otherwise was maybe the support we saw today. Today was inside price action after yesterday's bullish, otherwise, still bullishly trending higher highs, higher lows type of candle. It was definitely not the type of doji or close you want to see with that long wick. But today's, kind of doji close next to that means that, okay, we haven't picked a direction intraday just yet. But it does mean that a break below now the double, the 2-day lows here around 1529, 1530 are ultimately very important, because below that low, there isn't much in the way of any kind of stress test this market would take until we're back to, 1485, 1480, back to the lows of the month, basically. You basically could, erase the first day of the month's entire gains below that level, in my opinion. And again, that would be the market moving down into its next, another 50% retracement. I'm sure there's other trend lines we could find there if I dig hard enough, or other reasons to be bullish there. You could look at the old broken trend line resistance now being tested, as support there into the future. If you drew something through the highs to highs here, if you extended a line here from high to high to high, it would come through 1460 to 1480, right around that area. I don't have it drawn in the chart because I don't want to muck the chart up too much, and I keep specific trend lines on my charts for specific reasons. Specifically, these trend line supports in a trending market that's trending higher. We flip that in a market that's been trending lower. So with all that being said, very hard for me to say, hey, this is the bullish strategy I would tell you to get into today in the soybeans, because ultimately, many I know of my clients are already long, or we were long, and we've gotten out of positions, or and we're trying to reestablish, or have reestablished them in some of this intraday price action. But after such a run like this, I'm oftentimes starting to advise it's best to now wait for that little bit of more of a pullback, and a retest of $15 to $14.90 I think would be a gift, and a dip I'd buy. Below that area, we could open the door back to this congestion zone around $14. Certainly the 1380 full 15%, 1378 half is the exact level. Full 50% area could be an area to look out for in the soybeans, March contract, if it gives us, that deep of a pullback, which the way we've been trading over the last year, it certainly could. So, that really then brings up the idea of, okay, well, what do you do then at these types of price levels? Well, if you have bushels to protect an old crop, you could easily buy puts up here. Every few weeks, you could put on a new weekly or monthly expiration put, spend very few pennies and ratchet that up. You could sell calls slightly above that to bring that money in. And, it might not hurt to take a look out to new crop here. I flipped over scenes a little quickly there, because taking a look at that new crop bean, we're up to $14. I don't think it would hurt to put a floor in here at $13 to some capacity. I think that would be a wise thing to potentially do, and we could do so, through the, I would want it through the August timeframe, perhaps. You could do a short dated option, but okay, let's just take the straight November. Well, that's way too far out. The 260 days left on it November. $13 puts are still going to be, I'm sure, very expensive. I'm willing to bet they're going to be at least 50 cents. Yep, 60 cents there to own that put outright. But we can finance that by looking at the call side and seeing what's going to cost about 50, 60 cents to sell. Okay, at 15.20, let's just actually, gosh, I wish you could do the 15.30 for 60 cents. That would be perfect, because at 15.30 would be $1.30 above you. We're just going to use the 15.40 because I'd rather have a 4-cent cost here to get that extra 20 cents of upside in this type of environment. But I would expect it to be very hard for November 22 beans to go above the $15, $16 threshold, just like we saw November 21 beans do the same thing way back, last year when things were going inverted and what have you. So I think there's some of that, carry trade protection here, if you will. You're going to see that widening in the spread, which means the front month futures are getting that bid and that back month is lagging, meaning, any kind of short or downside exposure you have as a hedge in this new crop contract will not get hit as hard as that front old crop contract would. So, $13 call is going to cost us 60 cents to buy. Financing that by selling a 1540 call and bringing in 56 cents, a 4-cent all-day cost to have a floor at $13 right now in November 22 beans. I think that's a great protective strategy right now that we only really need to be worried about what to do if beans start to go in, particularly November. What I would only be worried about this, as beans start to approach that $15 mark. Then you have 40 cents between $15 and $15.40 to figure out what to do. You're going to probably see some significant time value decay between now and then. I mean, we're going to probably go there quickly if it does, but you can always buy futures at $15 to offset a November option there. Or, that's when you come and you look at some of these short-dated new crop options against a full November. You can get protection for the next 68 days and take the risk off to the upside if you're afraid of the market moving beyond that 1540 threshold, because that's really where your strategy here, a window or risk reversal strategy, selling calls to finance buying a put, which is what I've been talking about here for November 22 beans. And I'm going to write this one down because I did not have this one written down first before this video, but I just we talked about it. But that $14 put, again, going for 60 cents. That's all in the November 22 beans, and we're financing that, or excuse me, the $13 put, and we're financing that by selling the 1540 call, bringing in 54 cents there. So at an all-day cost, or 56 cents, wow, for an all-day cost of 4 cents to have that floor protection. Now, again, you put that new crop ceiling at 1540, but in all intents and purposes, 1540s are your first sales for your new crop. If you're not happy with that, then I'd have to have a long sit down with expectations in marketing with you. Okay, so cool. That kind of wraps up soybeans. We'll come back, and I'm sure I'll have more ideas to be throwing at people here over the next couple of weeks as we see volatility, develop. I'll probably try to do a strategy of the day update because I know markets are moving quickly, and all of this information is only valid for for as long as we can see it. All right, let's take a look at corn here. We're going to look at March corn, excuse me. We'll look at December too. And we'll look at a very similar risk reversal strategy for corn here too. How can we put in maybe a floor there for that December contract? Looking at a 550, 650, very similar type of idea there. All right, so, and I know 550 is probably not too exciting because of the cost of production next year, but we'll get there. All right, so on that daily chart of March corn, you can see how we have broken above old resistance highs, broken above that trend line resistance, and we've got very beautiful rainbow-like spread happening here in our moving averages. The 18-day moving average, yet again, comes in as a triumphant support for the market down at 618. That level, we'll look at again on the 4-hour chart here shortly, was a 50% retracement, a nice support here for the market to have held, and also the old highs, congestion zone that the market came back down into, holding old resistance, now a support. The 18-day moving average, along with that 50% long, had me being a buyer of corn this week. So one of the strategies here I'm putting in front of you is very blatantly just an outright long futures in December or March corn, excuse me, from this about this area. I think we can get away with risking around 10 cents from where we settled today at 617 for a swing that's going to take us up to 647 to 657. And we'll look at why I think that here in just a minute. But there's other ways of protecting, I think, that strategy as well. And we'll look at, maybe buying a put option, the 605 strike perhaps in the March with 2 weeks to go. Could be a way for 7 cents to get a floor there in a long futures position as well. And then, of course, in a minute, we'll look at that longer term strategy for how to, maybe position for a new crop with risk reversal strategy. Just like we looked at in soybeans, how do you finance buying a 550 call put, in that new crop contract by selling? In this case, we're going to be selling 650 calls. All right, so let's take a look at that 4-hour chart now for March corn. Pretty beautiful technical trend playing out here. We have broken out of our old congestion zone around the $596 mark, broke out above it, came back down to test it as support. That congestion zone was also a 50% retracement. You can see it there. It's highlighted blue from that 557 swing low to the 617 highs held at the 590 area. We've now traded up to its 61.8, negative 23.6, 631 technical target. Went through it a little bit. Once the trade does that, we start to measure from its old entry lows to its new target highs for another 50%, a stair step. The market's taking 2 steps forward, 1 step back. This is the very definition of what a trend is. With higher highs and higher lows in each swing, and each swing taking 2 steps forward and 1 step back, you have a market that's stair-stepping higher in a very, very definitive trend. That trend is now defined by staying above $6 in many ways, and certainly I think would help by staying above the 610 lows of today. So I'm a buyer here in the March corn, and certainly you can make a case for being a buyer in December corn too. But I think because we are still in inverted markets, and we will look at those old crop, new crop spreads very briefly here for both corn and beans to see how, I feel confident that those back months, right, the new crop spreads or new crop contracts aren't going to be rallying as hard as fast, and certainly not until the spring when we start to maybe build some carry back into the market after weather markets run their course. This 614 area was a highly anticipated level. Like I said before, the 18-day moving average, the old highs, now tested as broken resistance as support, and this 50% level of the full pullback for the month. If we trade higher now through the highs, I see us going to 656 in the next swing, and very likely would extend towards 680 to $7 in the next leg up of corn, if we are going to, continue in this bullish trend. Now, we slip and we fall back below $6. I do believe this market would be failing to break out of its old highs and falling back into the range that we've been in, and could run the risk of falling all the way back down to about $5. So I don't foresee that happening per se, certainly not with where input costs are right now, and not without a big decline in crude oil. We're going to sidebar for a minute, head over to crude, take a look at how the chart looks like there. Take a look at the bull trend that's ensuing. You can see very clearly a channel that's kind of trading higher. The old swings, we had supportive 50% around the 64.60 to 67.30 area. That congestion zone held. The next swing up takes us to the 93 to 95 with extensions above 100. If crude oil is going to test the $100 mark here, there's no way you're going to convince me that our large ethanol stockpiles right now are a threat to the corn market. We see ethanol crush continuing at a very strong pace, well ahead of what they need to hit the USDA targets. I think crushers are anticipating a strong demand from these summer months from out of the ethanol market because of these rising prices of crude oil. To keep gas prices down at the pump, ethanol is quickly becoming the only way this administration is going to be able to get that job done. The strategic oil reserves have been an epic failure. Remember when they let those go? Yeah, we were $20 lower in crude. It doesn't work. It never has worked, and it never will work. And the market is now forcing this administration's hand, in my opinion, to either make some major changes with the EPA and some of those blending mandates, or allow the market to do it for you. And certainly we're starting to see the justification for not only higher corn prices because of that strong ethanol crush, but also because, hey, the economy is absorbing it here with a high price of oil. So we'll see what happens, but I think this run in oil has given legs to the grain market, biodiesel, and ethanol markets. You've got a green light to turn bullish and start buying up stocks left and right, because gosh knows they're there to bid on. With all that being said, I promised a look here at some options for corn, because I do think while we're going to be, heading higher here, I think you still always got to protect the downside. I It's always where, if that's not where the conversation with whoever you're working for either marketing strategies or for execution, if that's not where the conversation begins, you should probably find somebody new to work with, because they are not keeping your best interests at mind. So again, this strategy now, thinking about the fact that we might head higher in the grain markets doesn't mean that we don't, just discount the idea that we need protective puts or some kind of protection for new crop, because this is some of the best pricing we've seen to start a year off that we've had in a decade. While we don't deny it could potentially get better, the strategy we're putting in front of you with a risk reversal allows for it to improve. In fact, up to $6.50 here in December 22 corn, you can still improve on that outright price, where $6.50 could become your first sale. So what we're looking at here is, again, I was looking at the July. I believe I was looking at the July. We're going to look at it real quick on both the July on December. So this is protection now taking us into the dead of summer. $5.50 put for 26 1/8 cents. Yep, that's right. That's not that bad of an outright cost, honestly. But the only thing is I don't want to be paying 26 cents in this type of environment to get a floor in the market at $5.50, because now my floor is down at $5.25 on the board. And by the way, and I know that break-even costs are going to be much higher this year, and we're going to need to maximize on where we get that floor. So at this point in the year, I'm going to need to find a way to help finance and pay for that. Well, I'm cutting that cost in half by selling the $6.50 call, which, by the way, from where we are right now in March beans, or in December 22 corn, still represents if we're at $5.70, call it an 80-cent improvement on the board from where prices are. So we're only bringing in 12.25 cents, but we're allowing our potential future sale price or our futures lock price to improve up to $6.50 from the current $5.80 price. But we're also allowing ourselves to get a $5.50 floor in the place now at a cost of 12.25 cents, or sorry, 14 cents. Got to round up that a little bit just to be safe, but it's actually 13.75. Bringing in at a 14-cent cost, getting that floor now at $5.36. So it's a little bit better, than what it was before. And again, those two option strategies can roll higher as the market moves higher, keeping that window for you. Usually, whenever we're doing one of those rolls, I'm looking for a 5 to 10 cent cost to improve it by 20 to 40 cents. So that means you're bringing your floor up and the window up higher, or in the call that you're selling higher, widening and increasing the band that you're looking at. So, and again, I also was looking at here. Let's say you're running that reownership strategy, going long futures. We like the price here. Outside of just putting a stop in around $6 or maybe around the lows of today and risking 10 cents to 607, you could take that same 10 cents and actually take 7 cents of it and buy that 305 or 605 put here that for the next 2 weeks of trading in the March contract can get you a floor in at 605. So I like that. Okay, it's 2 cents more costly than putting in a stop at $6. But this way you can't get taken out of the market in case the market, it does want to go down there very quickly and then, come back up and leave you behind. I hate getting kicked out of trades, which is why I oftentimes look at, as we come into option expirations like the March or even the weeklies, I like to look at, if we're trading futures, how do we afford a floor or a ceiling if we're short the market? How do we put in a stop using those, using a long option position? And by the way, that's also referred to as a synthetic call if we're long a future and long a put, or a synthetic put if we're short the futures and long a call. All right, so let's move on to wheat. Chicago wheat specifically here today, finishing down 3.25 cents. Actually, kind of an impressive close, all things considered, keeping a firm floor in the market down here around that 740 mark. The KC wheat here almost unchanged down the day, staying above 750. Kind of feels like that 200-day moving average is coming up to create a floor. And $9 trying to be the floor here, and the 200-day moving average for Minneapolis spring wheat. So I wanted to point this out because on all three of these charts, you have the 18-day moving average as resistance, 918s, the 200-day, call it $8.95, $9 as support here for the Minneapolis spring wheat. 200-day a little bit below us here at 736, but you can see the 18-day moving average coming lower and us slipping below that 100-day moving average here for the KC, but the Chicago wheat doing the same. The 200-day 743 kind of as support here. Markets have wiped away any form of overbought situation it had on the RSIs last week, and we've ultimately fallen from the high end of the range that we've been in since last November back down to the low end of the range, which is the 740 area for this Chicago contract. We did bounce off the low of the day in closing. 12 cents off that low was, or I guess it's only 8 cents. No, it was about 12 cents off the low. Was an impressive recovery for the day, but I would like to have seen it still close green to feel more confident. We go above the highs of today, though. We'll take a look at this smaller time frame chart now. Look down, drill down to that 4-hour time frame, because we go above the highs of today and certainly above the trendline resistance I have here drawn on the chart. That comes in around 760. I'd feel a lot more confident in a reversal. But we are at the low end of the range, and unless you were looking to put a floor in at 730, which is absolutely advisable at this point, we go below the current lows of this range, 630, 730 to 740 area. That's where I like to have a floor. If we go below that area, we could be slipping considerably lower, as much as $1 to $2 lower. There's no telling at this time of year for wheat. But if we hold this area, it does feel like wheat is trying to carve out a bottom to some degree. And we could head $1 higher, just that, in the range that we're in, to the high end of that range. And I think that while we're down here, we can, if you're looking for reownership, I think there is the opportunity to get into some, a 780, 880 call spread here. I was looking, I believe, at the May wheat here for this idea and opportunity. But the idea being is that a 780 call, we just got to get back to the highs of the month for it to go in the money. And the 880 call that you're selling is now above contract highs in many ways, at least in the March. I don't believe if we look at the May, it's going to probably be off by 5, 6, 7 cents. But nope, it is. It works just the same. 880 would put you right above contract highs, and that 780 would put you going above the highs of the month. So it's designed to make money if we're catching a bottom here in this low end of the range, and we're trading this range back up into the range that we've been in, like I stressed earlier. So again, kind of a no man's land here for wheat, so I don't have much to say technically beyond this larger range that we're in, and that today's recovery, if it starts to get legs, you have some key levels that if we break through technically, there's no reason we shouldn't go back to test at least $8. And I think, again, a 780, 880 call spread in May, it's got, let's switch over so we can look at those actual strikes here together. And again, 78 days left on May, so plenty of time left on the clock. And again, the short 880 call that you'd be able to bring in here, 11, just shy of 12 cents. If we can get 8 cents out of that over the next 78 days as this market moves around, that's awesome. We'll look to buy that back for anywhere between 5 to 8 cents of profit. So anywhere between 3 to 5 cents on that option to get out of it to allow you to just be long that 780 call. Now, that might mean at that point we roll the 780 call down. We spend whatever you make on that short option you bought back. But there is that plan in place, the idea to be able to increase your upside exposure if the trade you feel the trade's going our way or going the right way too. But again, all day long, only having a 21 cent cost because, again, the 880 call that you're selling, you're bringing in $11 or 11 3/4 cents, but you're going to have to pay for that 780 call the 32 3/4. 780 is very close to the money. It's a day's worth of price action away, so it's the type of strategy that we could see the market see the market rally up into. But we'll see. They don't ask us, do they? Okay. So now that we've looked at some of the option ideas, one last one. For wheat, I think that that May time frame is also interesting to look at downside here. I did say that the 730, 740 area makes sense, but at a 30 cent cost to get a 730 or 735 put for that same time frame, that means your break even's at $7. I wouldn't necessarily personally sell a put down in that area down there to finance that type of trade. This is where I think selling, the 880 call again, bringing in that almost 12 cents, you can cut down on the cost of owning call it 30 cents out of the pocket, get it down to 18 cents now. Your floor is now down around 720. That makes sense to me, a little bit better than just buying that 730 put outright and having a hard floor at $7. So, hey, want a way of getting that floor in for the next few months and into the hard springtime? There you go. Always, kind of got to think about that because, again, on wheat here, you break below this $7 area. There's not much there's not much back down here to $5. And on this March wheat contract, so got to be aware of that as well. So as I mentioned at the start, I wanted to also take a look here at the yeah, please get that. Take a look at July Nove soybeans and July Dees corn. Here's your July Dees beans, or July Nove beans. We're above the old contract highs at 127. That immediately becomes levels that we need to be aware of. But if we look at this spread last year, we got as high as we got in the $2 to $3 mark. So there's no reason I don't think we'll trade up there. We are into kind of our channel resistance here. So supportively, I expect the 120 area to hold. So this is why this uptrend here in this July Nove beans is a big reason why I don't feel super uncomfortable, right, being short in that new crop contract to some capacity, because as long as these spreads are heading higher, it's going to be driven by that new old crop bid, and you're not going to see as much loss to any kind of puts or short calls, long puts or short calls there in your old new crop contract. But wanted to at least point out that we could double where we are in that spread still. And then you got your July Dees corn here tagging and bouncing, I think, against or breaking, hitting, bouncing, battering. Yeah, there you go, battering up against this trend line resistance here at about 50. It breaks through. There's nothing really, I think, stopping it from going back to 70, 80, and I think really testing back towards this $80 to $1 threshold. This spread does have the ability to go to $2 over. That's about as wide as a corn spread will get. But the beans, they can go 3 to 4. And in this high inflationary environment, we might see these spreads go to their widest levels yet if we see, one, the inflation trade generally and globally continue, the energy trade generally globally continue, and of course, most importantly, continued strong exports and probably a weather market into the U.S. planting season. So, all right, well, that pretty much wraps up everything I had and wanted to cover for this week's Strategy of the Week update. There is not much to sink our teeth in that is bearish on these charts. There's certainly reasons to think about protection. From a marketing standpoint, I wouldn't be doing my job if we weren't talking about that to some capacity. But this is the time of the year where, I don't like to say and to sound like it's not an I told you so or it's more the woulda, coulda, shoulda. But we can look back and we can see where if we haven't placed some of those courage calls, if you haven't done those call spreads before these moves happen in a year like this, you're left kind of waiting and without much ability to improve on price, or having to risk more to improve on price in an environment where maybe it's even time to start thinking about locking in and being more protective of price. So it's always worth a conversation. There's something to be thought about. It depends on where you are, how sold you are, and what you need in your plan. And that goes for any kind of trading, whether we're trading oil, gold, any kind of product. Risk management is always and needs to be at the forefront of the trading decision and trade plan, because it doesn't matter if we're marketing grain or trading gold futures. It's the same type of idea that there is risk capital involved. The market is always moving, and that it's not about being right. It's about making money. So with all that being said, thank you for joining me this week. I hope you guys all have a great week, and look out for some more updates here into the end of the week and next week as markets are moving. Keep in mind that I do think this is a great time to be doing those cash sales. We're patting ourselves on the back for those that did courage calls and have gotten ready for this type of move, because those calls now give you the ability and flexibility and confidence to go do sales. And then on the other side of that coin, of course, if we haven't done anything, these aren't bad prices to start thinking about locking them in. And there's more than one way to do that, whether it's directly on the board via some of the risk reversal or window strategies I talked about, or via HTAs and other cash-based contracts that we'd love to talk to you more about over here at Zaner. So give me a call, everybody, 312-277-0110 to talk about your trade plan. Get involved in trading futures and commodity trading in general, or talk about trading and managing your commodity exposure risk. You can find me on Twitter, find me on Facebook, or shoot me an email at dhussey@zaner.com. Have a great day, everybody, and we'll be back with you as price action develops. Take care, everyone.